So in this video, I'm going to talk about post-audit and some other applications as they relate to capital budgeting. So the idea behind a post-audit is to go back after the fact, after a decision has been made, maybe a year or two or a couple of years down the line, to evaluate how things have worked out for a particular project. The basic idea is those projects were based upon projected cash flows. Your decisions may have been affected by some errors in forecasts or perhaps some incorrectly applied methodology or something of that nature. And the idea is to basically go back and look at what decision was made, how that decision was arrived at, whether it was a good decision or a bad decision, and basically to try to learn from those mistakes and what you did right as well. And it's basically providing feedback on the process. And if you get some feedback on the process and you realize, you know what, it looks like across my different projects, I'm consistently overestimating revenues and underestimating costs. And hopefully what that means is um, maybe the forecast can get better and we can do a better job of the forecast. And I'll actually talk about forecasts in some subsequent videos. So kind of stay tuned for that. And the goal here is to improve operations and basically get better at the capital budgeting process. So that's an important part of the capital budgeting process. Go back and look at what was already done and evaluate it and make sure that you're learning from it whatever you can. Now, it is kind of important to note that really, the kind of the capital budgeting idea and sort of the process and the metrics and things like that could possibly be applied to some other areas as well, not just strictly capital budgeting. So if you think about a company when they hire somebody, in a sense, really what they're assuming is that they are going to generate more in terms of profitability by hiring the person than they are going to spend in terms of total benefits. And that's not to say that there's any exploitation or anything like that going on. And some businesses could do some things that are exploitative and so forth. But just because that is the motivation of the company does not mean that's any kind of exploitation or anything. It's just basically recognizing the fact that for the company, they think that they're getting more value for their dollar than they're paying, basically. And really, that's actually true for consumers broadly when we buy something at the store. If I buy something at the store, the implication is that I personally feel like I'm driving more value or benefit from whatever it was that I'm buying than the value of the money that I'm giving up to buy it. If I thought the money was worth more than what I'm getting in exchange, I shouldn't buy it, right? So with that in mind, companies are kind of having to evaluate basically what kind of return do they get. They're investing a whole lot of money in terms of compensation and maybe training and things like that and employees. So what kind of return on investment are they getting? Well, one way to kind of think about that would be if they're spending all this money on that employee, what kind of return on investment in terms of future cash flows are they getting? And in a way, you could actually kind of do some capital budgeting on that and kind of assess, just how much productivity would an employee need to have given all this cost of training and everything else for it actually to make financial sense for the company to hire somebody. Does it actually pay off or not? And now, as a side note, if a company happened to analyze you and your job, and they concluded that it looked like a negative net present value proposition, meaning it looked like they're paying more to have you working for them than the benefits they're receiving by having you working for them. If that's sort of a negative net present value proposition for the company, I think the odds are pretty good that the prospects are very limited for that position, unfortunately. You also, if you think about it, could kind of apply the same sort of methodology or approach to stock valuation. So really what capital budgeting is looking at is what does it cost me today relative to the present value of the expected future cash flows, right? And so I'm comparing those. So if it costs me $100 today, if the present value of expected future cash flows is 120, I take 120 and minus the $100 it costs me today, $20 positive. That's the idea behind net present value. If it's positive, we're getting more value than what we're paying, right? That's the same idea behind stock valuation. If I value a share of stock and I conclude that it is worth $75, but it's only costing $50, then I pay 50 to buy something that I think in today's money is worth 75. Well, that suggests that the stock is a good deal, right? So it's that same actual idea of comparing what I expect to receive in terms of present value with what I expect to pay in terms of present value. And ultimately, if it looks like I'm going to receive more in terms of present value than what I'm paying in terms of present value, we like it, right? That's good. And so from that standpoint, I do the same thing with stock as with capital budgeting and machinery and so forth. As a little kind of side note, if you are perhaps if you're pursuing a college degree or thinking about a graduate degree or something of that nature, Really, you can apply the same kind of process to a college degree. All right, how much are we spending to get the college degree? What are our expected increases in income later, right? We can do some time value money on this and kind of figure out, does it actually pay to finish the degree? There's a fair chance that it might, but that doesn't suggest that every college degree would work out with that analysis. So you really would have to run the numbers. How much am I paying? How much of a benefit do I receive? And in terms of present value, let's compare it and see, does this actually make sense? Now, as a little side note, which I can't resist pointing out, having been a teacher for a very long time at the college level, one of the things to kind of think about as it relates to that is one of the ways you could improve that calculation would be to graduate on time, or better yet, early. Because then that means you generally save money in terms of tuition spent and also time spent, and you start reaping the benefits earlier, which makes the present value of those future cash flows larger, and generally the money spent to get there smaller. So graduating on time is a good thing. You wind up with a lower initial investment and better future payoffs. So just as a little side note, graduate on time and make sure you pass classes and things like that, and also do kind of think about what you're doing in terms of a degree or a minor or concentrations or things like that, and what does that do to the relative amount being spent and the initial investment? What does it do to the amount you're getting later? Worthwhile things to consider. That doesn't mean that every area of study inherently will look like it is positive. Some areas of study can have benefits that are beyond the monetary. But I would hazard to point out, since I'm sort of on this little tangent, that if it doesn't have benefits that are monetary, and if it doesn't look like the amount spent actually equates to a higher enough future earnings to make it worthwhile from a financial sense, you might not want to borrow a bunch of money to do it if it doesn't actually financially pay off, right? So it doesn't mean that all areas of study have to show positive returns on investment necessarily. But it does suggest that you probably don't want to borrow a bunch of money to do something that doesn't have a positive return on investment, because it would be more difficult to pay off the loans in that case. So something to kind of think about. Anyway, but you could use this kind of approach in a whole lot of different areas as well. So ultimately, it's that thought process of, what's the present value of what I'm getting? What's the present value of what I'm paying for this? To make sure we're getting more in terms of present value than what I'm paying. So whether that applies to buying a piece of equipment, buying a share of stock, buying a business, it's ultimately that same kind of concept. So those kind of processes really kind of apply more broadly than just capital budgeting. Hopefully this video has been interesting and helpful. Thank you so much for watching, and have a great day.